Hi friends, welcome to Finogyan. Today's topic is the best smart investment plan for 2018. Friends, we are in 21st century where everything is becoming smart, like smartphones, smart cities, smart TV, etc. Then why not means we can make a smart investment plan to earn good return, safety and liquidity. Don't you think it's a good idea? Of course, this is. There are many investment products available in the market which gives good return. Gold, currency, fixed income, mutual funds, stocks and real estates are most common investment products where people invest as per their financial capability. But one should have smart investment strategy so that their investment gives safe and high return in short period of time. Friends, at present, at present, equity market or you can say investment market scenario, especially equity market has become very volatile and oversold compared to previous years, and so mutual fund is. Real estate has become stagnant since last 5 years, and fixed income interest has been reducing from 9% to now it's 6.5 or 7. So the investment market has become very complex, and it is not an easy task to decide where to park the surplus fund. So in this situation, one should make a smart investment plan to invest the surplus fund so that one can get good return safely and in short period of time. So how to make a smart investment plan? Let us follow the four step which will clear the idea. First is fund allocation. Firstly, one should allocate fund for investment. The fund should be a surplus of his daily or monthly needs. It should not be taken on loan or any credit. Means he should not borrow from others and then put it in some investment, and then after 2 months, 3 months, I need money and all. So this should not happen. So it's a surplus of daily needs, and it should not be taken from loan or some credit card or some other source of credit. Second step is time frame of investment. So once the investor allocate the fund, then the second step is to decide the time frame. How long one can invest the fund for example, 3 months, 6 months, 1 year, 3 years, etc. So he has to decide. The investor has to decide the time frame for investment. The third step is return expectation. The third step is return expectation. How much return the investor is expecting from the fund. Suppose he is allocating 1 lakh and it is for 3 years. So what is the return he is expecting from that return? And the fourth step is very important. The fourth step is the risk taking capacity of that person. As we all know, high risk earns higher return. If age of an investor is between 25 to 35, then the investor can take more risks than a person at the age group of 50 or 60 years old. Similarly, if an investor is 30 years old with 3 4 dependent can take less risk than a investor having no dependent and zero liability at the age of 50 years. So one has to check his risk taking capacity and categorize them in three groups, namely high, medium or low. Suppose he can take more risks than if an investor is willing to take more risks, then his group would be high. If he is medium, then medium, and if he is not able to take any risk, then it should be in a low category. Once the above four step that we discussed, a smart investment plan is made. The investor has to select the investment product. Now an investor want to invest say 1 lakh, and for a time frame of say 3 years, and return expectation is say 10%, and risk taking capacity you can say is medium. Then you put this in a table and then you select the product. So fund allocation say 1 lakh. So you can go for real estate. Real estate is not possible because it requires huge capital. Time frame of investments at 3 years. Fine. Return expectation 10%. So fixed income and gold is not possible in this category because his expectation means you can't get fixed income and gold 10% return. Then his risk taking capacity is medium, where currency is not possible because currency is very volatile in this market and now it is on a peak. So guys, now we'll come to the conclusion, solution, or you can say the solution of the best smart investment plan. Based on the above, one can easily find out the investment product. For example, one cannot go for real estate as I said, gold, fixed deposit, income because of the first huge capital required. So the investor has only left two options, equity and mutual fund. Equity market is again it's oversold at this point of time, so it is advisable to invest at least 60% in equity. There are many A group beaten down stocks are there, so one can invest there. So once market is started recovering, an investor will earn a very good profit. And 40% in mutual fund through SIP route. Again, mutual fund through SIP route is a very profitable thing, rather investing at a time in a mutual fund. And if he is once 60% of his fund he is taking risk in equity, so if mutual fund he should invest in debt equity combination portfolio. So guys, friends, I think this way one can chalk out his own smart investment plan, which will give good return, safety, and liquidity. A good return if whatever he is expecting, safety, so that he should not make an investor should not make loss in his of his in capital, and liquidity whenever an investor requires say 1 year, 2 years, 3 years. Time horizon, he should investor should get the fund back. Friends, I hope this is clear the smart investment plan, and thanks for watching this video. Hope you like the video. Please share the video if you like. Thank you.